If you could take just $10,000 today, put it somewhere safe, forget about it, and one day wake up to see it growing and paying you thousands every single month, would you do it? Of course you would. The problem is, most people don't know where that somewhere really is. They chase trending stocks, risky crypto coins, or random YouTube advice, but the truth is, the most powerful wealth-building vehicles ever created aren't hidden in secret. They're sitting right in front of us, inside something called index funds. See, when people talk about the stock market being risky, they're usually talking about trying to pick individual companies, one by one, guessing who'll go up and who'll go down. But an index fund is like owning a small piece of hundreds, even thousands, of companies at once. Instead of trying to predict which business will win, you just buy the entire race, and over time, that race has one direction, up. Now, the idea of buy and hold forever might sound boring to some people. But the truth? That's how every quiet millionaire is made. They didn't gamble. They didn't time the market. They invested in smart, diversified index funds and let time and compounding do all the heavy lifting. And that's exactly what we're going to break down today. The 6 best market index funds you can buy, hold, and let them work for you literally forever. Let's start with the one that almost every financial expert agrees on, the S&P 500 Index Fund. This single fund holds 500 of the largest and strongest companies in America. Think Apple, Microsoft, Amazon, Google, and Johnson & Johnson all rolled into one basket. You're not just investing in a company, you're investing in America's entire economic growth. The beauty of it is that the S&P 500 has returned, on average, about 10% per year over the long run. So if you invested $10,000 and just left it alone, reinvesting your dividends, in 30 years, you'd have over $174,000, without lifting a finger, without checking charts, without stressing over daily market moves. Now, different companies offer their own versions of this same fund. For example, Vanguard's VFIAX is one of the most popular ones. Then you have Fidelity's FXAIX, which has extremely low fees, and Schwab's SWPPX, another solid choice for long-term holders. The reason these are so powerful isn't just because of what they invest in, but because of how cheap they are to own. Low expense ratios mean more of your money stays in your pocket, compounding over decades instead of being eaten by fees. But the S&P 500 isn't the whole market, it's just the biggest companies. That's why the second powerful fund on our list is the Total Stock Market Index Fund. Vanguard's version, VTSAX, is legendary. It doesn't just hold the 500 biggest companies, it holds nearly 4,000 different U.S. stocks. From massive giants like Apple and Tesla all the way down to small, up-and-coming companies you've never even heard of. So when the small caps grow, you benefit. When the large caps dominate, you still benefit. It's the ultimate, own everything, strategy. Now imagine holding both, an S&P 500 fund and a total market fund. You've already covered almost every corner of the U.S. economy. But why stop there? The third index fund that every long-term investor should consider is the Total International Stock Index Fund. This one gives you exposure to companies all around the world, Europe, Asia, Africa, Latin America, everywhere. Because even though the U.S. is powerful, it's not the only engine driving global growth. There are growing giants in emerging markets, like India, China, and Brazil, and they're reshaping the global economy fast. Vanguard's VXUS or Fidelity's FTIHX are two great examples. The key to holding international funds is balance. You don't want to bet everything on one country. Think of it like this: if something bad happens in one economy, the others keep you floating. It's like a financial life jacket that keeps you safe while still letting your money grow steadily over time. Now, let's talk about the fourth one, something more specific, but incredibly powerful, the Nasdaq 100 Index Fund. This fund is filled with the top 100 non-financial tech-focused companies listed on the Nasdaq exchange, names like Apple, Microsoft, Nvidia, Amazon, and Meta. This one is more growth-oriented, meaning it moves faster, up or down. But over the long term, It has outperformed many other indexes because of how innovative its companies are. Fidelity's FNCMX or Invesco's QQQ ETF are perfect examples. A lot of people use Nasdaq funds as their growth engine. They put maybe 20 to 30% of their portfolio into it, because even though it's riskier, the rewards have historically been massive. If you'd invested $10,000 in QQQ 20 years ago, it would be worth over $170,000 today. That's the power of technology leading the world forward. Now, number 5 is one most beginners ignore but the pros love, the Dividend Appreciation Index Fund. Here, instead of chasing high growth or risky stocks, you invest in companies that not only make profits, but increase their dividends every single year. Think about that, you're getting paid to wait. Vanguard's VDADX or VIG ETF are examples that track companies like Coca-Cola, Procter & Gamble, and McDonald's, businesses that have weathered recessions, wars, pandemics, and still paid their shareholders more money each year. Over time, this creates a compounding snowball. Your dividends buy more shares, which pay more dividends, and so on. And that brings us to the 6th and final one, the Total Bond Market Index Fund. It's not as exciting as the others, but it's crucial for balance. Bonds are the steady anchor that keep your portfolio stable when stocks get shaky. Fidelity's FXNAX or Vanguard's VBTLX are great options. Bonds might not make you rich quickly, but they protect what you've built, giving you peace of mind and predictable returns. Think of it as the financial brakes in your wealth-building car. You can go fast with stocks, but when things get rough, bonds keep you safe. So now you know the 6, but here's the secret that separates successful investors from everyone else. It's not about picking them, it's about staying with them. It's about discipline. It's about understanding that the market isn't your enemy. Time is your best friend. Every crash you see on the news, every correction that scares people away, those are opportunities. Because when you're holding great index funds, you're not holding random stocks. You're holding the world's best companies. And history shows that those companies always recover, stronger than before. Imagine this. You put $10,000 into these index funds today, you don't touch it. You let it reinvest, you keep adding a little each month, maybe $200 or $500. Fast forward 20 or 30 years, you could be sitting on hundreds of thousands, maybe even millions of dollars. That's not magic. That's not luck. That's math. That's compounding working silently in your favor. Vanguard founder John Bogle once said, "Don't look for the needle in the haystack. Just buy the haystack." And that's exactly what index funds let you do. You're not gambling on one hero company. You're owning the entire market. Every time the economy grows, every time new technology emerges, every time a business succeeds, you benefit. And the best part? You don't have to be rich to start. Many of these funds let you begin with just $1, $50, or $100. Fidelity, Schwab, and Vanguard all have zero commission platforms now. You can automate your investments and forget about them. The key is consistency. Small amounts over time beat big amounts done once and abandoned. Now, let's talk briefly about fees, because that's something most new investors overlook. If you pay even a 1% annual management fee, over 30 years, that could eat away nearly 25% of your total wealth. That's why index funds are special. They're passively managed,